Welcome to the 2026 Dialogue, a masterclass series by the HR Association of India. I am Neha Jagnani, and today we'll be exploring a topic that highlights the expanding role of finance leaders in shaping the future of business. Our theme for this session today is the modern CFO, driving growth beyond financial performance. To help us explore this important conversation, we are delighted to welcome Mr. Venugopal Rao Pendyala. Venugopal is the Group CFO at Autoline Industries Limited with over 3 decades of experience spanning finance, manufacturing, engineering, business transformation, and Industry 4.0 initiatives. He has successfully integrated finance with technology and operations to drive EBITDA growth and enhance organizational performance. A strong advocate of digital transformation, he's currently pursuing a Doctor of Business Administration with a focus on AI led finance transformation. He's also a qualified independent director certified by the Indian Institute of Corporate Affairs, bringing a strategic and future focused perspective to financial leadership. Venugopal sir, thank you so much for joining. It's a pleasure having you.
Thank you, Neha. Uh, Already the introduction has been done, so nothing more about me. So kindly, kind for introduction.
Sure.
So the topic modern chief financial officer is no longer defined only by accounting accuracy and financial controls and statutory compliance. It's usually talked about the CFOs. The role now extends across enterprise strategy, capital allocation, technology, operations, and even to the greater extent, risk, talent, and stakeholders' confidence also you need to get out of it.
Right.
So if you carefully see, it is much more beyond. So some of the places actually it has been felt as a chief financial officer is no more chief financial officer. He is going to be chief future officer. And
Right.
accounting perspective, if you see, there is something like a financial accounting and management accounting. Financial accounting is given, so that is what activities which has already took place. Then finally, you are going to do it. Management accounting is the one which is really needed in this time, where a lot of strategic financials involved, strategy involved, and which is going to help the CEO and CTOs to formulate their strategy so that how actually company is going to move forward. So this can be applicable for the service industries, manufacturing industries, or operation driven industries, or anything other trade industries as well. So
Sure.
from that perspective, if you see CFO's role gone much beyond what actually it was in the past. So, and even AI driven technologies at the same time, other technologies like Industry 4, where core data and much more authentic data is available for the decision making purposes. So, well defined topic. I think whoever is going to experience this, the topic is going to be much more interesting.
Sure.
Yes.
Sure. Thank you so much. An exciting perspective to start with, sir. And looking forward to this masterclass. To begin with, my first question for you is the role of CFO. As you rightly said, has evolved beyond just finance. So I want to know, how can today's CFO become a key driver of business growth and strategic decision making?
So in my viewpoint, the modern CFO must move from being only the custodian of numbers to becoming the architect of enterprise value. Financial reporting, compliance, taxation, and controls remain fundamental, but they are now the minimum expectations are from the CFO. The larger responsibility is to translate financial information into the business choices. So, strategic CFO should understand the complete value chain from customer demand, pricing, the product mix, what is really going to have, because product mix varies with the price, to procurement. Capacity utilization also equally important because whenever you are accepting the order, it's imperative for a company to see whether capacity utilization is there or not. Then capital expenditure comes in picture. So which was not there, so we are experiencing today. the productivity, how productivity levels are moving. Core important aspect of the working capital and the cash conversion, whether cash conversion is happening at right time. So the CFO must participate before decisions are taken. Aftermath story definitely will be available when you are really going to look at the accountings, not merely evaluate their financial impact afterwards. So much more proactive approach is needed with the CFO side and giving a right time feedback to the MD, CEOs, and as well as the stakeholders who are actually involved in the system. This will help them and as well as the organization to sustain all sorts of pressures which are coming out, which are unpredictable and predictable nature in both. So, for example, if I take an example, when the business proposes a new capacity,
Hmm.
the CFO should not restrict the discussion to capital expenditure and approvals. So what he need to evaluate is whether confirmed or reasonably visible demand support the investment, the expected utilization and break-even levels, customer and product concentration risks at the same time. Funding structure, how it is really going to be, how it is really debt equity or only equity or debt, impact on leverage. Because debt, anything you want, it's going to take considerable amount of time to get from the banks or any other organizations. Working capital requirement after commissioning, it becomes at later stage. Time required to convert capacity into revenue, receivables, and cash is the most important aspect because whenever you are investing into the capex, the first year it will be the negative cash flow because you end up in only investing and you end up in paying the interest. But revenue comes in next financial year. So turnaround point of view, how faster your payback is going to be, how faster your capex is getting converted to the ROI. This is the most important aspects. So these are the core things which I feel is the beyond financial stewardship which is there. So in nutshell, I just like to say modern CFO does not merely report where the business has been. The CFO helps determine where the business should go next.
Sure, thank you so much. Great perspectives there. So, finance function has truly evolved the role of CFO from just being the custodian of number to the architect of financial value. And as you rightly said, working capital and cash conversion will still be critical, but leaders have to now be very proactive in order to be business
Correct.
enablers. So, to end with, do not just report, what has happened, but a finance function is now determining what is best for the business. So, thank you so
Yes.
much for your inputs. My next question, Venugopal, is with AI and digital transformation reshaping businesses, how should CFOs balance innovation, risk, and financial discipline?
So to start with, like the CFO should approach the digital transformation as a business value, business value program, not merely as a technological expenditure. So every initiative involving AI, automation, you can call it as ERP, analytics, robotics or industry 4. These are operation centric, not directly related to the service industry, should be connected to clearly define the business problem. Because every technology which is going to be there, which is associated with the organization, should always value addition. Should be. So it is not just merely coming as a technology or some fancy things, not like that. So the first question should not be which technology should we buy. It should be like in the way, what problem are we solving? What value will it create? How will that value measurable? Who will own the outcome? Particularly, most of the places what I have seen is IT division which is actually buying the technology and implementing. They become a change agent, but they should not become a directly responsible for all these things. The stakeholders who are actually working off online or any other department to take full responsibility and that ownership really pave the way for the right outcome which is going to be there. So it's I can call it as a disciplined investment framework. I can call it as. So it has got a several things like it has got a strategic relevance. It has got a financial value. It has got a execution readiness and risk governance need to be seen.
No.
So not every digital investment will deliver an immediate conventional return on investment, which usually we expect it to be faster, right? So you invest today and you are going to get a value out of it immediately. But always it is going to be the future. And once integrated approach is used, should be used within the organization to implement this particular AI or digitalization, or you can call it as automation, because the people who are absolutely involved in the doing a lot of manual activities, it is very difficult for them because manual activity, whoever is doing, they become a self, you can call it as a, they become a owners of that and they become indispensable knowingly, unknowingly. So in that fashion, if you wanted to give a technology, what happens is now it is as good as like giving their trade secrets. So it's very difficult to convince them. So once you know the outcome, taking everybody into the confidence, and we need to communicate back to them that this is really going to reduce your effort. What sort of effort? And it is many of the repetitive activities they are doing, they get bored and they are not in a position to give you full productivity. So it is imperative for us also to see that bifurcate between what actually value added activity, non-value added activity for a person. So value added activity can be with them. Non-value added activity, which is not supposed to be doing, can be immediately converted to the technology, which in my company also we follow. And whenever technology comes in picture, there is a risk associated with that. Like whenever technology booming, virus will come, then there is antivirus will come. Same way now, cyber security playing a major role in it. Recently, Bajaj attack, the past Jaguar Land Rover, sometimes the Honda also is there. So those things actually matters.
Sure. Thank you so much, Venugopal. So, just to summarize, I think the biggest takeaway was that approaching business transformation as a business value is very, very important. And, it's very important to ask the right questions. What problem are you trying to solve? What you will achieve, how you will measure the output, and will it reduce the effort, the usage of AI? So, very, very important takeaways. Thank you so much. Moving on to the next question, Venugopal, is modern CFOs are expected to influence business strategy, operations, and people. How can they create value beyond the balance sheet?
So actually, what happens is CFO when he gets involved in that, he can improve the underlying drivers of financial performance. You can call it, you immediately you can note down something like a revenue, then EBITDA, profit and cash flow or outcome actually out of it. So modern CFO must influence the operational causes behind these outcomes.
Right.
So if we can take an example, couple of examples I'll give you. Revenue depends on capacity, right? Launch readiness, customer mix, and delivery performance. And moreover, these days, as such, the prices are going up at, you can call it in automotive industry, steel prices are going up. So whenever steel prices are going up, the lag period which is there till the time you give a price increase, they will not give you steel so easily. What they do is they expect you to pay in advance and as well as later part they are going to roll out and give it back. The cash, the cash trap is going to happen for the companies. So CFO, actual CFOs are the people who does know all these things. So they can play a vital role in it. Then another thing is the margin depends on the material cost, productivity, pricing discipline, quality, and opening leverage. And if you carefully see, all these things again comes under the CFO because he is the guy who is actually releasing the cash,
Right.
when to release the cash, and taking care of all compliances, right? So there are fixed compliances. See, you have to pay TDS before 7. You have to pay GST before 10th. It's extended, otherwise 20th is. Like that, many regulations which are there with government posts, which are directly linked with your performance. Otherwise, and whatever the EMS which are there, you have to pay well within time. Otherwise, it will get reported as CIBIL and there is a problem for the trade ratings. So, what I'm saying is there is a completely ecosystem which needs to be fully understood by CFO and they have to play a much more vital role. Then cash flow depends on the speed with which business activity is converted into the collections. So It is imperative for CFO to see that when my receivables are going to be there after credit period, and the working capital point of view also need to be seen. Then it's the game of account receivables and payable. More and more automation. Maybe if you really wanted to deploy something, you can deploy something like a AI into it. Then reconciliations which are there consume a lot of time. If you'll be able to bring a more technology to reconciliation, like there are something like a GST reconciliation softwares are there are TDS reconciliation softwares are there. Then there are many softwares are there which are actually going to help you to understand the financial modeling. So these are the ones actually can be done through CFO. Again, an IT arm with the CFO, or many companies, if you see, CFOs are becoming the IT strategists. Like in my company now, as well as like I'm a CFO, because ultimately at the end, whether it is cash, whether it is working capital, whether it is operational efficiency, these are numbers which are going to be outcome of your operational performance. So relevant enterprise value measures capacity utilization and overall equipment effectiveness, and many other components which are there part of the company. So CFO has to play a role in involving himself to the into the operation. Need to see where actually value propositions are there, where he can help, and he can immediately uh, uh, early warning, you can call it as early warning can be given, and support top management. So CFO also creates value through governance, strong controls, transparent reporting, and discipline decision making to reduce surprises and improve stakeholder confidence. At the same time, the catastrophic situation like what we are facing right now, unpredictable change is happening in the market because India is no more a developing country; it is almost developed country now, exposed towards the global. So whatever is happening outside is going to impact you because you are consuming. The import, export, or balance of payments are really there. So the CFO creates value beyond the balance sheet by improving the business drivers that ultimately shape the balance sheet. So finally, it is important. Our real tool is the balance sheet.
Sure.
Yeah.
Sure. Thank you so much. Just to summarize, Venugopal, understanding the ecosystem is very, very important. The speed, meeting to the timelines, automation, reconciliation, software you should deploy, which will help your process speed up and save time and effort. This has been a part of the role now. And so CFO is helping not just via a balance sheet, but optimizing its resources through governance and operations as well. So thank you so much for your input. This brings us to the last question, Venugopal, which is in an era of economic uncertainty, what strategies can CFO adopt to deliver sustainable growth while maintaining financial resilience?
So immediately two things coming to my mind, two priorities you can say. Simultaneously they have to happen again. Protect the core business and preserve the capacity to grow. These are the two things which, in uncertainty, it has to. Excessive caution can weaken future competitiveness, while uncontrolled expansion can create liquidity stress. Many companies which I have seen, when real problem comes in picture, they enhance their capability through the R&D. They do more and more developments and for the future readiness.
Right.
So in uncertainty, again, CFO has to play a role because only conserving cash, if he is going to suggest, it is difficult for a company to further grow because when things become better, you will not have any future readiness and you will have a serious problem, and the growth is not going to be the CAGR never grow. So the starting point is scenario based planning. Instead of relying on one annual budget, the CFO should evaluate base upside and downside scenarios. So more and more scenario planning will actually pave the way for to management to decide which scenario they can adopt and how actually the blended scenarios can be made. So each scenario should consider demand, pricing, raw material costs, interest rates, foreign exchanges, customer concentration, supply chain disruptions. So these are the ones actually call it as the variables, you can say. So there are a lot of variables mean you can have a sensitivity parameters. So even you can go for the volume point of view regression analysis, and for other places you can always take a forecasting. Previous trends are not going to help you because things are moving so fast paced. The previous sprints are not going to work out. So organization should then define specific trigger points and actions. For example, if demand decline, inventory, manpower, discretionary spending and capital expenditure should adjust quickly. That's the most important aspect. So right now you can say the ERP side, I'm not recommending, but SAP HANA has got so many features. It's automatic inventory management and backflushing when it's going to take place, it's going to give you, and it will become a tool for you to control the inventory. It can call it as FG, it can call it as the WAP, all those things. So the organization should know which capacity, funding and supply chain actions must be activated. So in uncertainty, all these things are most important aspects. So quickly, I can say the six pillars of financial resilience, which CFO has to practice, is the liquidity, working capital, profitability, capital allocation, very, very important aspect, risk diversification, and operational flexibility. So growth must eventually strengthen cash flow. Return on capital and organizational resilience, not merely increase the turnover. So, moreover, a lot of proactive action needs to be taken. So, like it is more than a doer type of this thing. He has to be something like a little bit more creative and innovative and adapting more technological advantages, less manual activity, more technology oriented approach, and forecasting with the facts is going to make a huge difference for CFO. So that's a way CFO has to act. So this the clear viewpoint which is coming out from the various incidents, which even in my career, which I have experienced and which I'm seeing now outside part of my CFO forums, wherever discussions are happening as a part of panelists.
Sure, sure. Thank you so much. Beautifully put together, Venugopal.
Yeah.
So, the importance of scenario-based planning, forecasting, very, very important. Defining those trigger points and actions in terms of uncertainty, funding and supply chain to be activated. Then creativity and technology-driven approach equally plays a critical role in today's times, given the volatile working landscape, and of course the six pillars that you mentioned. So thank you so much. This brings us to the end of this masterclass, and on behalf of HRAI, thank you for your insights today. Very candid, and you have reminded us that the role of CFO has truly evolved from being just a financial steward to a business enabler, to an architect of business growth. So thank you so much for your inputs today.
Thank you, Neha. Thanks, HRA.
Thank you. Thank you.